1 year ago, there was 51 billion in inflows, so 26 billion in outflows. That tells you where sentiment really is towards investment products. And I think we've priced in this very ominous outlook already into the market. That's why I just don't think that going back and retreating to those October lows is credible without some form of an exogenous event.
Well, how have we priced in? How have we priced in? We haven't even priced in a recession.
Well, okay, sorry.
Our earnings, have we priced in an earnings decline from where we are now? We haven't really.
I think we have. I think we've priced in earnings are going to be down 7% on the quarter.
We haven't priced in.
I think valuations got ahead of that last year and saw what was coming, that there would be margin compression. You saw valuations correct in all equity sizes, classes, and strategies.
I want to make sure I'm clear on this because right now I'm not.
Okay.
You think that the stock market has priced in a recession?
Yes, I said that 4 months ago on Closing Bell with you. I say that again today. Stock market is priced in a recession.
I mean, when you look at the multiple expansion, right, you have to be convinced then that this is the trough in earnings this quarter because the multiples expanded to 18 times.
So $220 is the trough.
Right. And that 200 is not priced into the market. When the market goes up
because
4 months
in a row,
hold on, Jenny, when the market goes up 4 months in a row, I don't think it's priced in. If the market went down 4 months in a row, I'd say, yes, it's priced in. Have certain stocks priced in? Yes. Has the market overall? Absolutely not. I don't know how you can draw that conclusion.
Joe.
You're cherry picking your time frame. I think what the market correctly.
I'm talking about today. You're saying today.
The market correctly, during the course of 2022, priced in what was coming ahead, priced in the earnings recession. The market is a very efficient discounting mechanism, and I think the market did its job June, July, August, September, October, even into the end of the year with a lot of mega cap equities and pricing in the environment where we would see earnings contract, enter the earnings recession. We certainly had the valuation recession. And I think the market has also understood that there's been this rolling recession, as Ed Yardeni keeps talking about, not a universal recession, that there are select industries that already are in recession.
I don't. Rolling recession's one thing, okay? I mean, and that's kind of a strange term, okay? Nothing falls off the cliff all at once, not every sector. So doesn't mean to me the rolling recession, if those companies seeing a recession, then they're going to recover in those sectors, right? I think that you'll see the others come down as well. And that I just go back to when the market multiple has expanded to 18 times, which is far above the historical multiple, I just don't see that as pricing the recession. Now, I agree with you that now we're not going to hit the old lows. I think that's completely out of the question. Is it 3,400? Is it 3,500? I don't know. But I also don't believe we're off to a new market.
I didn't say that.
Bull market.
No, I didn't say that.
But if you priced in a recession already, what's the next step?
Because that's in fact why the market has had a 20% recovery from the fall. It's already priced in the worst case scenario.
Right.
No one is sitting here and advocating that we're going back up to 4,800. I'm not saying that. You need a tremendous amount of good feel in the market for that to occur. But I think the market has done its job.
Well, you're talking about price. You think the price has already marked the low.
Discounted, reflected.
And in fact, earnings as well.
It remains to be seen whether earnings.
So what's your downside? What's your risk reward in the market?
Jenny Harrington.
Thank you. I'm dying here.
Really? I couldn't tell.
Poor Scott. You need to manage me, and it's not easy. So it's interesting because if you look at a chart of what the market multiple is based on historical inflation numbers, what you see is that we've steadily moved in exactly the right direction. So as inflation's moved from 9% CPI a year ago to 5% now, what multiple of the market, so I don't think you should look at that historical multiple. I'm not sure that's the right way to deal with it. I think you need to say, when inflation's at 5%, what's a reasonable market multiple? And when you look at this data, you actually see that this kind of like 16 times to 18 times makes sense. I think Joe is completely spot on that in the middle of October is when we were really discounting $220 earnings. When I was on last week with you, Bob Pisani was on, and he showed us quarterly numbers for the S&P.
You're assuming if the $220 of earnings is the trough.
And I think it is. And if you look at Bob Pisani's numbers by quarter, you see it's like $50 for Q1, $50-ish for Q2, and then they really start to pick up. And it seems like that's a more reasonable place to be heading. So I think we're heading to $240 earnings in 2024. You take that, you put 18 times on that, and it's actually kind of reasonable. But this is where I just want to get back to the Mike Wilson thing for one sec, because I don't think the right way to frame the question is, are we out of the bear market? I would argue that we are definitely out of the bear market. And to Jim Cramer's point about the market showing resilience, I would argue that we've been showing resilience since the end of October last year. So that time frame has been longer. I think the real question is are we in the clear with the bull market? Right? And like, if you look at a chart of the market, we've been so range bound. I'm not sure we're in the clear with the bull market, like really surging to new highs, but I think we're out of the woods with returning to October 2022 numbers.